Good evening, students. Welcome to the session. Have you revised the trust taxation, what we have done in the last class? Yes, we had dealt with different kinds of trust taxation. We had done the private trust taxation, we had done the AIFs, then we had done with the securitization trust. Yes, have you dealt with that? Yes, all of you. Because today we are going to start first with the real estate investment trust and then we are going to move with the charitable trust. Yes, good evening Prerna, good evening Shankara, good evening Sailesh, good evening Viraj. Yes, very good Viraj. Okay, so I'll just quickly recap what we have dealt because there has been a long gap. Okay, so I'll just quickly revise what we have done in the last class. I told you, first of all, that we have different kinds of trust. One is the charitable or the religious trust. Then all under that as well, we have two regimes, the Section 1023C, which is the first regime, and Section 1112A, the second regime. Then we have the private trust. Then we have the political parties. And then we have the securitization trust, AIFs, and the REITs. Okay. So first we started with the securitization trust. What was the objective of the securitization trust? The securitization trust was with the specific objective of the keeping the assets and monetizing the assets for the banks. So basically, this is only for monetizing the assets of the bank, in which the banks pledge the assets with the securitization trust. In return of that, they get the funding, and these securitization trusts issue the security receipts by getting the funding from the investors. Now, the income of the securitization trust is exempt. These are known as the pass-through entities under Section 1023BA. The income is exempt. But whatever amount it pays to the investors, okay, whatever amount it pays to the investors, so, and whatever income the banks get, so income by way of interest from the banks that it generates, that income is taxable in the hands of the unit holders. So whatever amount it is getting from the bank, that is not taxable in the hands of the trust, but it is going to be taxed in the hands of the investors in the like manner and to the same extent. Now, this is applicable for all these types of trust, which is the securitization, AIFs, and the REITs. Now, just that in all these three categories, the kind of taxability for different income varies, but they are more or less pass-through entities. All the trusts are more or less pass-through entities. Only for certain respect of income, they have the taxability in their own hands. So whatever amount it pays to the investors also, on that, they need to deduct the TDS under 194 LBC. For the resident individual or HF, it's 25%. For resident others, it's 30%. And for the non-resident and foreign company, it is at the rates in force. Okay. Then we discussed, yes, good evening, Namrata, good evening, Geeta. Then we discussed about the alternate investment fund. Now, these are very specialized or skilled investment pooling fund trust which are there. So wherein they collect the investment from the unit holders and then they invest in certain specialized classes of asset. So for the AIF, if it is a PGPP income, it is taxable in the hands of the AIF. If it's company AIF, it's 30% or 25%. If it is a partnership firm in AIF incorporated in the form of partnership firm, it's 30%. If it is incorporated as a trust, then it is at the maximum marginal rate. In the hands of the unit holder, this PGPP will be exempt. Okay. Now, in respect of the losses which are arising out of PGBP, those are to be carried forward and set off at the fund level itself. Those will not be passed on to the investors. Okay. Now, for that, if you remember, we had done this kind of sum also where there was 2 lakh rupees losses. We had first set it off against the income from other sources at the fund level, and the balance income was taxable in the hands of the unit holder. Are we clear? Then in case of the other income, it is exempt in the hands of AIF, meaning it will be passed through, it will be taxable in the like manner in the hands of the unit holder. There will be TDS under 194 LBB for resident, it's 10%, for non-residents, rates in force. And now, if the losses are there, if the units are held for greater than equal to 12 months, then losses are allowed to be carried forward and set off by the unit holders. The firm cannot set off. And if the units are held for less than or equal to 12 months, then losses cannot be set off and carried forward by the investors. But with regard to the allowability in the hands of the fund, the act is silent. So if you remember, there was this income from other sources of 2 lakh, which was negative, which was basically a loss. First, we set it off against the PGBP. So there was no loss which was remaining. So we didn't carry forward at the level of the fund. So only if there is a loss which is remaining after the carry forward and set off during the current year, only then it will be allowed to the investors. Are we clear? Yes, any questions, any doubts till now? Yes. So this was about the AIFs and the securitization trust. And then we did the taxation of the private trust. I told you there are two kinds of the trust. One is the revocable trust and the other one is irrevocable trust. Revocable trust is that basically if it contains any provision for retransfer of the income or assets directly to the transferor, basically to the settlor, or it gives the transferor the right to reassume the power over the income of the assets. Then in that case, the income is taxable in the hands of the settlor only or in the hands of the transferor only. In case of the irrevocable trust, then in that case, the transferor does not derive any benefit or the trust is not revocable during the lifetime of the beneficiary. Income is not taxable in the hands of the settlor. Okay. Then I also told you if the transfer is made to the trust for the benefit of spouse or daughter-in-law, then it will be clubbed under section 64 in the hands of the settlor only. Now, in case of the transfer made by the settler to the trust, in case of irrevocable transfer, it is not regarded as transfer under 47. Also, this will not be considered as 56(2)(10) income for the beneficiaries or for the trust also if the beneficiaries are relative. Now, in case of irrevocable trust, again, we have two categories, the specific trust and discretionary trust. If it does not have any business income and it's a specific trust, then the share of the beneficiary will be taxable in the hands of the beneficiary at the slab rate. If there is business income, it will be taxable at MMR. The exception is if the trust is for the benefit of relatives, then in that case, it will be at the slab rate. If it's a discretionary trust, meaning the shares of the beneficiaries are not known, then if there is no business income, it is taxable at MMR. And exception is if there is no beneficiary having any other income greater than basic exemption limit and it is beneficiary only in this one trust, or the trust is declared under will, or the trust is for the employees, then in that case it will be taxed like AOP. And if there is business income, it will be taxable again at MMR. But the exceptions are there that the trust is created by will or it is for the benefit of relative or it's the only trust of settler, then it is taxable at slab rate. I'm sorry. In case of trust, who will be taxed? The representative assessee is going to be taxed. Who is the representative assessee? The trustee is going to be the representative assessee. I'm so sorry. Are we clear? Okay. Yes or no? So the income of the trust is going to be taxed in the hands of the trustee as the representative assessee. Any questions, any doubt till now? Yes, students. Mansha, exemption in the hands of AIF as per 2023 FBA. Okay, you are asking about the exemption in the hands of the AIF. 1 second. I didn't get your doubt exactly. So this you are asking for the other income in which head it is exempt, under which section it is exempt. Is that the doubt? Yes. So there are two exemptions, Mansha. One is the exemption of the income of investment fund, which is the other income other than the PGBP. That is under 1023 FBA. So, okay, this should be FBA and not FBB. You're correct. This should be FBA. You're right. So other than the PGBP, it is exempt in the hands of the investment fund. And in case of the PGBP, it is exempt in the hands of the unit holder. This is under section 1023 FBV. Yes, Mansha, very good. Nice observation. Yes, Mansha, I got it. I have made the correction also over there. Okay. Any other questions, students, before we proceed on? Okay. Now we are going to proceed towards the third category, which is the real estate investment trust. REIT. Now, what are the REIT, students? Do you have any idea with regard to the REIT or infrastructure investment trust, the InvITs? What are the REITs or InvITs? Yes. Any idea? What are REITs or InvITs? So these are two trust or the investment vehicles which are notified by the SEBI. Now REITs which are there are the trust or the InvITs are basically the trust which are set up. These are registered with the SEBI and these have basically the three parties, like we have the settlor, trustee and the beneficiary. They have the sponsor, trustee and the manager. So instead of trustee, they call them as manager under the REIT. So there is a sponsor, then there is the sponsor, manager, and the trustee. The trustee or the manager is one and the same. And then there are unit holders. Now, how does this REIT taxation function? Let us try and understand very, very carefully. What are REITs? We will first understand through first understanding how these REITs function. Now, in the case of the REITs, what happens is these REITs basically have the investment in the real estate. Okay. So the REITs which are there, they basically have the underlying asset. They invest in the commercial real estate assets. Either they hold it on their own on a freehold basis or on a leasehold basis. Now they invest either directly or they invest it through the special purpose vehicle. So basically, they either invest in land or any buildings or any kind of warehouses. So all of these immovable assets, the real estate assets which are there. Are we clear? Now, basically, how does this particularly work? Now, the units of the REIT are listed mandatorily on the recognized stock exchange. And the REIT has to mandatorily invest not less than 80% of the value of the REIT assets shall be invested in the income generating property. Balance 20% can be invested in any other government securities, bonds, or any other assets which are there. Basically, the securities which is there. Now, basically, how this particularly function. So let's try and understand with the help of the example. As I said, there is a sponsor which is there under the REIT. Okay, there's a sponsor which is there under the REIT. So first of all, the sponsor who is there, he would start a company. He would have a company. So he would be a sponsor of a company, which we will call it as SPV, which is the special purpose vehicles. So let's say, for example, the sponsor is there of the SPV. Now he would invest in the REIT. He would invest in the REIT. So he will get the units of REIT. Now this REIT is going to have the investment in the SPV, which SPV will then invest in the immovable property. So it may directly also invest, and it can invest indirectly also through the SPV. So this sponsor of the SPV, who is owning the SPV, will invest in the REIT. He will get units of the REIT, but how he is getting units of the REIT? In exchange of the shares of SPV. So the shares of the SPV are given to the REIT, and in return he is getting the units of the REIT. Are we getting that point? Now, in this particular case, you will notice that there is a transfer of the asset which is happening. Under Section 247 of the Income Tax Act, the transfer includes the exchange. Transfer includes the exchange. So isn't there a transfer happening at this stage when the shares of the SPV are exchanged for the units of the REIT? Isn't it? Are you noticing that there is a transfer? Isn't it? Yes or no? So will there be capital gain at this particular point? Yes. Yes, students. Will there be capital gain at this particular point? Who issues the REIT, Mansha? The REITs are basically held by the different unit holder. So basically, the sponsors who are there, they form this REIT, and these REITs are registered with the SEBI. Yes or no? Okay. So yes, there will be a capital gain on this exchange of the shares of the SPV for the units of the REIT. Yes or no? Yes, students. What do you think? Whether there will be capital gain? Yes, there could be capital gain, isn't it? But this capital gain, Geeta, the absence of the consideration is never a requirement. For capital gain taxation, there is never a requirement that there has to be a consideration which should be present. Because if you look at it, the consideration is there. You are getting the consideration and can be in cash as well as in kind. The consideration is the units of the REIT. For the shares of the SPV that you are exchanging, Geeta, you are getting the consideration in the form of the units of the REIT. That is your consideration. It is not necessary that there always has to be a monetary consideration. We have so many examples where even if there is no consideration, there has been a capital gain. One of the classic example is the Section 45(4) now, Section 9(b) now, right? Or the conversion of capital asset into stock in trade, where there is consideration. Still, it is considered as capital gain. Conversion of capital asset into stock in trade results in a capital gain. There is no consideration there. So, presence of a monetary consideration is never an ingredient. What is required is that there has to be a transfer of a capital asset. And transfer includes the exchange. Right, Geeta? But why this is not considered as taxable capital gain is because, yes, Mansha, there could be a capital gain. Why there is no capital gain over here? Because this is not regarded as transfer specifically under Section 47. This is not regarded as transfer under Section 47 of the Act. So section 47 of the Act, 47(17), specifically excludes this from the definition of transfer. Are we getting it? Now, if this is not considered as transfer under section 47, obviously, when the units of the REIT are sold, at that time, there will be the capital gain. So, when these units will be sold, there shall be capital gain arising at that point. In that particular case, since the units of the REIT are listed assets, are listed securities, there will be STCG taxed under section 111A at the rate of 15%, LTCG over rupees 1 lakh taxable under section 112A at the rate of 10%. Now, what will be the cost of acquisition of the units? What shall be the cost of acquisition of the units? Yes. And what shall be my period of holding? These answers you have to give me. Yes. What will be my cost of acquisition of the units? Yes, students, faster. What will be the cost of acquisition? Fast, this is very easy. At the time when the shares transferred, yes, Geeta, at the time when the shares are transferred, you are saying the fair market value. But the units are transferred, Geeta, not the shares. The units of the REITs are transferred, not the shares, Geeta. Yes, students, please apply your mind. What shall be the cost and the period of holding for the units? Faster. Nobody knows the answer. Think about it, students. It's very simple and very logical. Have you paid anything for the units? No, we have not paid for the units. These units are received in exchange of the shares of the SPV. These units are received for the shares which are exchanged by the sponsorer. In consideration of that, they are receiving the units. So what is the logic that we have always seen in capital gain? Cost of the previous asset. When the compulsory convertible debentures are converted, or when the compulsory convertible preference shares are converted, it is always the cost of the original asset. In case of amalgamation, in case of demerger, What is the cost? Cost of the previous asset, right? So here also, my cost of acquisition of the units of the REIT will be cost of the shares under section 49. This shall be the cost of the shares of the SPV. And even the period of holding shall be clubbed. The period of holding of the shares of SPV shall be clubbed under section 242. Whether any indexation will be available, students? And what will be the period of holding? 12 months, 24 months, 36 months? Yes, students. Whether there will be any indexation which will be available? Yes. Yes, students, any indexation which will be available? Pastor, I mean, I need the answers. We are almost on the verge of completing your domestic tax syllabus. And you're not there with your answers. Aren't you revising your direct tax papers? These are simple questions that I'm asking, which you have already studied so far. If you're not going to answer, you will end up making mistakes in the examination. Do you want that? No, right? So please give me the answers. Yes, students, will there be any indexation? What will be the period of holding? Are you there with me? I'm not getting any answers, so I'm assuming that nobody is there with me. How would I know to whom I'm teaching? Yes, Namrata, no indexation. Any particular reason, Namrata? Jigar, yes, you are saying there will be indexation. And what will be the period of holding, Namrata, Jigar? 36 months, 12 months, 24 months. Students, if you're not going to give me the answers, very quickly, what I'll do is I'll just finish off the chapter and then it's up to you. So I'm trying to put in a lot of efforts. And if you can see already, my health is not well today, but then still I'm having that 3-hour lecture just for you, right, guys? So I need your answers. Yes, Mansha, no indexation. Yes, very good. But what is the reason? Jigar, there will not be any indexation. And what about the period of holding? Yes, Geeta, it's more than 36 months. Yes. So there will be no indexation, students, because we are going as per section 112A. The units of the REITs are covered under 112A because they are listed. And under 112A, we don't get any indexation, right? So there will not be any indexation, guys. Secondly, in terms of the period of holding, it will not be 12 months because for 12 months, it is only the listed shares and the equity oriented fund, not the units of the business trust. Secondly, it will not be 24 months because it is not unlisted security. Only the unlisted security and the immovable property has 24 months. So then it will obviously be covered under the 36 months criteria. Are we clear? Okay, so just write down the period of holding is going to be 36 months. See, this is such a simple question, but you can end up making mistake in the examination if you are not able to recollect it. So if you are going to give wrong answers, you will be able to recollect it better, students. Yes or no? Okay. Yeah. So let's proceed further. Now, this is the first step of the REIT, that how the REIT are basically formed. Now, under this, there is one more important thing which we have to remember, recollect. Now, that's your job to recollect. Under the MAT, we had done one adjustment to the book profit with respect to the REIT. Do you recollect that? Under the MAT, I'll just take you to the MAT chapter. See, notional gain or loss on transfer of share of SPV to a business trust in exchange of the units of the business trust is to be added or reduced. And the actual gain or loss on the units transferred of the business trust is to be added and reduced. So basically, the notional loss is to be removed from the book profit, and the actual gain or loss is to be considered under the book profit. Are we getting that? So basically, here if you can write down the notional gain or loss on the transfer of shares of SPV in exchange or for units of business trust need not to be considered for book profits for MAT calculation. The actual gain or loss on the transfer of units of business trust is to be considered for MAT. Okay. So here since we are not considering the actual the notional profit or losses even for under section 47, this is exempt, right? Under section 47, this is exempt. So even for the purposes of the MAT, we are not considering the notional gain or losses. We are only considering the actual gain or loss. Are we clear, students? So this is how you have to recollect the provision. Now see, if you would have just read in MAT, you would have forgotten by now when you are doing the REIT. So this is how to interlink the provisions wherever it is applicable and not read in isolation. Clear? Okay. Now, as I said, this is the first segment of the REIT. Now, next is when the income is being earned, when the REIT is starting to earn the income. Now, as I said, the REIT can invest directly in the immovable property, or it can invest by way of the SPV. Now, take a first scenario where give this as number 1. The step number 2 is, let's say my REIT is investing in immovable property. Now it will generate the rental payments, right? It will invest in the real estate assets. So it will generate obviously the rental income. Now the rental income which it is generating, now this rental income, how is this to be taxed? Now this rental income which is there, this is a pass-through income. This is going to be a pass-through income. So on this rental income, in the hands of the REIT, this is going to be exempt under section 1023 FCA. This is going to be exempt under 1023 FCA when it is investing directly in the real estate property. Are we clear? Secondly, if let's say for example, now the rental income is being paid by somebody to the REIT. Now usually when somebody pays you the rental income, there is TDS under 194I, right? Which the payer has to deduct the TDS while making the payment of the rent. But in case when the rent is being paid to the REIT, then in that particular case, the TDS is not deductible. So there will be no TDS under section 194I because the income itself is exempt. Now this income therefore will be taxable in the hands of the unit holder under section 115 UA. So this income which will be distributed to the unit holder will be deemed to be the income of the unit holder. The REIT has to deduct the TDS under section 194 LBA. Under section 194 LBA, for the resident, it is 10%. For a non-resident, it is at the rates in force. Are we clear? Yes. So for the resident, it is 10%. For the non-resident, it is at the rates in force. Clear? Now the second alternative is it is investing in the SPV, which will then invest in the immovable property. Are we clear? Now, when it will invest in the SPV, let's say it will invest in the SPV and the SPV makes the investment in the immovable property. Now it is not directly going to generate the rental income. The rental income will be of the SPV. The rental income in the hands of the SPV will be taxed in the normal way. Only for the direct investment by the REIT, we have the exemption under 1023 FCA. So when it is investing in SPV, it is not going to generate any rental income because the immovable property is going to be held by the SPV. It is not going to be the rental income of REIT. So what income it is going to earn from the SPV? One is the dividend and the second one is going to be the interest. So one is the dividend, and the second one is going to be the interest. Yes, students. Now, when it is earning, let's say, for example, the interest income. Now, when it is earning the interest income, what will be the taxability of the interest income? Now, the interest which is going to be earned by the business trust, by the REIT, again, that interest will be exempt in the hands of the REIT. There will be pass-through status given to the interest under 1023 FC. Okay. So in the hands of the REIT, this is going to be exempt. Here, usually when the interest payments are being made, the TDS is required to be deducted under section 194A. Since the income is itself exempt, there will not be any requirement of SPV to deduct the TDS while making the payment of interest. So, no TDS under section 194A. Are we clear? Now, in the hands of the unit holder, this income by way of interest will be deemed to be the income of the unit holder. So, this will be taxable in the hands of the unit holder. Now, in case of the resident, unit holder, this is at the normal rates. However, the TDS will be under section 194 LBA at the rate of 10%. In the case of non-resident, this shall be taxable under section 115A at the rate of 5%. Right? And again, the TDS will be under section 194 LBA at the rate of 5%. In all the other cases, you saw that for the non-resident, it is at the rates in force. But here, it is at the rate of 5%, the taxability as well as the TDS under section 194 LBA. Are we clear? Yes or no? Clear? Now, this is about the interest that it gets from the SPV. Clear? Now, the dividend that it earns. From the SPV. Again, this dividend is exempt in the hands of the business trust. This is exempt completely. This is exempt under section 1023 FC. And in the case of the unit holders, there will also be no TDS under section 194. There is no requirement to deduct the TDS because this is exempt. Now, this will be taxable in the hands of the unit holder only if you have to decide whether you have to ask a question for the unit holders. You need to ask the question whether the SPV has exercised the tax rate under section 115BAA. Whether the SPV has exercised the tax rate under section 115BAA. What is the tax rate under 115BAA? Yes. What is the tax rate under 115BAA? Yes, Geeta, 22%. Right? So the dividend taxability in the hands of shareholder depends on the answer to this question whether the SPV has exercised the tax rate under 115BAA. If the answer to that is yes, then in that particular case, dividend taxable in the hands of unit holder under section 115 UA. Dividend taxable in the hands of the unit holder under 115 UA. And what will be tax rate? The tax rate in this case will be, if it is a resident, then in that particular case at the normal rates of tax. But there will be TDS under section 194 LBA. TDS under 194 LBA at the rate of 10%, which is same to the dividend, which is same as interest. For the interest also there is under 194 LBA, right? So in that particular case, there will be TDS under 194 LBA. In the case of non-resident, the tax rate shall be 10%. The tax rate shall be 10% under section 115A. For interest, it is 5%. For dividend, it shall be 10%. And the TDS will be under section 194 LBA at the rate of 10%. Are we clear? Where the SPV has not exercised the tax rate under 115BAA, if the answer to that is no, then dividend exempt in hands of unit holder. So if the SPV has not exercised the 115BAA concessional tax rate, then dividend will remain exempt in the hands of the trust as well as in the hands of the unit holder. Yes or no? Yes? Any questions? Any doubt? Are we clear up till this point? Okay. Now, if there is any other income which is earned by the business trust, any other income apart from that, which could be other than the dividend, interest, rental income. Let's say the capital gains which are there. So if it is, let's say this is any other income. I'm writing here. If it is long-term capital gain, if it is long-term capital gain, then under section 112 at the rate of 20%. Long-term capital gain under 112 at the rate of 20%. STCG under section 111A at the rate of 15% under that section itself, and any other income at the rate of maximum marginal rate. Any other income will be taxable at the maximum marginal rate. This shall be taxable in the hands of REIT. This shall be taxable in the hands of the REIT. And this then will be exempt in the hands of a unit holder under section 1023 FD. So then what is taxable in the hands of unit holder? One is your rental income. Okay. So that is taxable in the hands of the unit holder. Second is interest. Third is dividend. Any other income is taxable in the hands of the REIT itself. It is not going to be taxed in the hands of the unit holder. That is going to remain exempt. And there will be TDS on all the dividend, interest, rental payments at the rate of 10, at whatever rate it is, under 194 LBA. Yes? Any doubt till now? Yes or no? Yes, Geeta, I will give you a way out as to how do you remember. Yes, Namrata, I will summarize at the end. See, this is a very, very simple topic, yet difficult to remember, but there is a way out for everything. And in case you get this kind of question, this is entirely cash marks. And expect a question around this area because there is an amendment under this topic. That is what we are going to cover. We have not yet touched upon the amendment. But before we move further, there is one last important point before we move into the amendment. There is also a possibility that this REIT has borrowed the funds. Right? It could have borrowed certain funds. So on this, it is to pay some interest. Right? Now, this taxability of interest is not important because that is something which is, we have to deal with it, of course. But there is one more important point is the TDS on that interest. Right? So if, let's say, for example, the interest is paid to a non-resident lenders on the foreign currency borrowings it has taken from them. So if they have given the borrowings in the foreign currency, so the business trust who is paying the interest income to a non-resident, okay, this is liable to deduct the TDS at the rate of 5%. And such interest will also be taxable in the hands of the non-resident at 5% under 115A. So this could be borrowed funds from non-resident. So interest taxable at the rate of 5% under section 115A and TDS under section 194 LC at the rate of 5%. Okay, this should be the borrowing in foreign currency. This should be the borrowing in foreign currency. However, if let's say, for example, if the monies are borrowed by way of the INR or in the rupee denominated bond, if the monies are borrowed in rupee denominated bond, or if the money is borrowed on a long-term bond, which is there. Are we getting that? So if the REIT is listed on a recognized stock exchange in IFSC, then the TDS shall be and the taxability shall be at the rate of 4%. Up till the borrowings till 30th June 2023. After that, the TDS will be at the rate of 9% as well as the income tax will be at the rate of 9%. So, you can write it over here. This is an amendment as well. If borrowings by REIT listed in IFSC and borrowings in rupee denominated bond, then tax at the rate of 9% after 1st July 23. Tax at the rate of, I'm just taking it upwards so that, tax at the rate of 9% after 1st July 23 and tax at the rate of 4% before 30th June 23. Okay? Yes or no? Fine? Yes, Namrata, I will do that. Last point is the amendment over here. Now, this is very, very important. This amendment is very, very important. But before that, I'll try to summarize so that you have the clarity before we move to the amendment portion. Yes, students? Okay, let's try and understand once again. So the first part, what we were trying to do is, I said how the REIT is coming into existence. The sponsor of the shareholder of the SPV, the SPV's sponsors or the SPV's owners will exchange the shares of the SPV, which the REIT will now have the holding. So initially, the company is being held by the shareholders. Now what I'll do is, the REIT will take over the shareholding of that company. That will be called a special purpose vehicle. Why is it called a special purpose vehicle? Special purpose vehicle is there to hold the investments in the immobile property or any others. They are formed for a specific purpose to hold something. They are basically the holding companies. Now in this case, the REIT will take over the shareholding from me of the SPV. And in return, the REIT will give me the units of the REIT. Now I'll become the unit holder of the REIT. So this exchange of the shares of SPV in return of the units of REIT is not considered as transfer under section 47. So this you can remember. You don't need to remember the subsection, but at least you need to remember section 47. It is not considered as transfer. That is number 1 point. Also on this notional gain that is arising, the MAT is not applicable. You have to take that notional gain or loss out of the book profit. Correct? Now, when the units of the REIT are sold by the by the sponsor, at that point of time, there will be the capital gain. If it is short term, it will be under 111A because the units of the REIT are always listed. If it is long term, it will be under 112A, wherein it will be taxable only when it is more than rupees 1 lakh at the rate of 10%. Right? Now, what will be my cost of acquisition of the units? It will be the cost of the original shares of SPV under Section 49. Section 49 is always the cost to the previous owner or cost of the previous asset. That you can also remember. You don't need to remember the subsection. What will be my period of holding? Period of holding shall be 36 months. And we will club the period of holding of the shares of the SPV while calculating the period of holding of the units under Section 242A. This also you can remember very easily. And the actual gain or loss which is arising can be subjected to MAT. That will be included in book profit. Is it clear up to this part? Yes or no? At least tell me yes or no. Yes. Up till this point, are we clear? Yes, Mansha. Okay. Others? Yes, Gita. Fine. Others also, please be with me because these are very easier topics. You may feel that this is difficult and you may omit it. But this could come for exam and can make the difference of 50 to 60 marks for your exemption or 30 to 40. Yes, Namrata, I will repeat it once more. What I'm trying to say is when the sponsorer gets the units of the REIT in exchange of the shares of the SPV that he is holding, that is not considered as transfer under Section 47. Number 1. That will not be subjected to MAT. Number 2. When the units of the REIT will be sold, at that time the capital gain will arise. Correct? It is listed. Therefore, the capital gain short term will be under 111A at 15%. Long term I will be 10% over rupees 1 lakh under 112A. The cost of acquisition will be the cost of the shares of SPV because you have not paid anything for units. So it will be the cost of the previous asset. Similarly, you will club the period of holding under 242A and the period of holding will be 36 months. And this actual gain or loss will be considered under MAT. Is this clear? Yes or no, students? Yes or no? Faster. Are we clear now, Namrata? Yes, yes, yes. I'm not getting more answers. Are you with me, students? Yes. Okay, let's proceed further. Second part is when the REIT starts generating the income. Now, it could earn the income from the immobile property, which it is holding directly, or it can earn the income from the SPV, which will hold the immobile property. So, REIT can either hold the immobile property directly or through the SPV. When it is holding the immobile property directly, it will earn the rental income. The rental income that it will earn will be exempt in the hands of the REIT. If you can't remember the section number, forget it. Don't remember the section number, but at least you remember that yes, it will be exempt. Yes, this will be exempt. Now, when the rental income is exempt in the hands of the REIT, it will be taxable in the hands of the unit holder. This shall be taxable in the hands of the unit holder. Yes. Now, if it is taxable in the hands of the unit holder, there has to be the TDS under 194 LBA. This you have to remember. The TDS for all the income which is distributed by the business trust to the unit holder is under 194 LBA. On the rental income, For a resident, it is 10% TDS. For a non-resident, at the, it is at the, yes, it is at the rates in force. Clear? That is under 194 LB. Secondly, when it is investing in SPV. Now the SPV will earn the rental income, but what it will distribute to the REIT is either dividend or interest. Now if it is distributing the interest, if it is making the payment of interest on the funds which have been given to the SPV as loan, the interest income will again be exempt in the hands of REIT, not taxable in the hands of the REIT. There will not be any TDS. So this will be generally taxable in the hands of the unit holder. For the resident, it is normal rate. For the non-resident, this interest is taxable at the rate of 5% under 115A. 115A talks about the tax rates for the non-resident on the interest, dividend, royalty and FTS. The TDS will remain under 194 LBA, that is same. It will be 10% for resident, for non-resident it is 5%. Then if it is distributing dividend, again dividend is exempt in the hands of REIT. There will not be any TDS. In the hands of the unit holder, it will be only taxable if the SPV has opted for the tax rate of 22%. If the SPV has not opted for the tax rate of 22%, dividend will not be taxable in the hands of even the unit holder. If it is taxable in the hands of the unit holder, it will be again taxable at the rate of normal rates for resident, for non-resident at 10% under 115A. The TDS will be 10% under 194 LBA for resident, and for non-resident it is also 10% under 194 LBA. Any other income will be taxable in the hands of REIT. If it is LTCG, it is at 20%. If it is STCG, it is number 111A at 15%. Any other income will be at maximum marginal rate. This shall remain exempt in the hands of the unit holder. If the REIT is making payment of interest on the funds it has borrowed, the interest will be taxable at the rate of, again, 5% under 115A. But for the IFSC units, for the IFSC listed REIT, it will be 9% after 1st July 23 and 4% before 30th June 23. Are we clear? Yes or no? Now is it clear? Yes? Yes or no? Yes, students. Now is it well summarized and well cleared with you? Before we proceed with the amendment and one sum that we are going to solve on this. Yes, Geeta? Perfect. Now the amendment to this is, listen to it very carefully. See, in respect of the REIT is distributing the funds to the unit holder either in the form of dividend, interest or rental payments that it is earning. But it was also distributing to the unit holder as the repayment of capital. As a repayment of capital, it is distributing the funds to the unit holder. Now, this repayment of capital is or was not taxable specifically under any of these provisions. So, therefore, this was not getting taxed in the hands of the unit holder. Because of this loophole, the amendment has been introduced by way of Finance Act 2023, which now provides that if the REIT repays the capital to the unit holders, so if the REIT is repaying to the unit holder other than by way of dividend, interest or rental payment, then in that particular case, there will be taxability under the head income from other sources. So this has been the latest amendment that has been made under income from other sources. Now you will ask, ma'am, you did not teach us while we were doing the IFOS chapter. Yes, because I wanted to teach over here. If you remember, I told you that time itself. So if you look at it, the section 115 UA, which talks about the income of the unit holder, which says that the income of the unit holder, which it is receiving through the REIT, will be taxed in the like manner and to the same extent. The same provision that we have under AIF and under the securitization trust also. However, it only covers interest, dividend, and the rental income. That's it. Any other income is exempt in the hands of the unit holder. However, it was noticed by the tax department that the REITs distribute the income to the unit holder as the repayment of the debt as well. So dividend, interest and rental income is fine. But there are also distribution made by the REIT to the unit holder, which is shown as repayment of the capital or repayment of the loan. That is not taxable, but that is actually an income of the unit holder, which does not suffer any taxation in the hands of the trust or in the hands of the unit holder. So in view of that, to capture that loophole, the provision has been introduced which provides that now when the sum is received by the unit holder, you can write it over here. Sum paid by REIT, or you can write with a red ink since it's an amendment, paid by REIT to unit holder as repayment of debt, as repayment of the debt. Now this or redemption of the unit held by unit holder, right? Now this will be specifically taxable, chargeable under income from other sources under section 56 to 12. Under section 56 to 12. Finance Act 20. Okay. So this is particularly for the repayment of any loan or for the redemption of the units. Okay, so any other sum which is received by the unit holder from the business trust, which is not in the nature of dividend or interest or the rental income, and which is not specifically taxable under 115 UA. Okay, now this will be taxable under the 56 to 12. This shall be taxable under 56 to 12. Now, how is this going to be taxed? Understand the taxability of this. So 56 to 12 gives us the formula for that. And what is the formula? A minus, write down, taxability shall be, taxability under 56 shall be A minus B minus C. Now, what is my A? A is the sum distributed by the REIT. A is the sum distributed by the REIT. Okay, A is the sum distributed by the REIT with respect to the unit. Okay, which could be during this year or any other earlier previous year, which is not in the nature of dividend, interest, and the rent. P is the cost of acquisition of the unit. B is the cost of the unit. And C is the amount if taxed under this section in earlier previous year. Okay, because A considers the amount which is distributed in this year as well as in the earlier previous year, other than interest, dividend, or rent. B is the cost of acquisition of unit and C is the amount if it is taxed already in the earlier previous year that has to be again excluded from the A. Now, if B and C are greater than A, if this is resulting in negative, so this shall be 0. If answer is negative, it shall be considered as 0. Okay. So this is what is going to be taxable. So what you are distributing minus the cost that you have. So the excess basically is going to be taxed under 56 to 12. Are we clear? Yes or no, students? Are we clear up till this point? Shall we solve a question on the REIT from your module itself? Let me give you the question from the module. Once you solve the question, I think this will be very, very clear to you. A business trust registered under SEBI gives particular of its income, interest, dividend, short-term capital gain on sale of listed shares of Beta. So Beta is an Indian company in which the business trust holds 70% of the shareholding. Short-term capital gain on sale of properties. Interest received from investment in unlisted debentures of real estate companies. Rental income from directly owned real estate asset. Assume that Beta does not opt to pay tax under 115 BAA and discuss the tax consequences of the above income earned by the business trust in the hands of the business trust and the unit holder, assuming that business trust has distributed 10 CR to its unit holder in previous year 23-24. Yes. Go through the question and start giving me answer for each one of it. First, give me the answer for interest. Yes, what will be the taxability of interest? Yes, students, please be faster. Yeah. Okay. So interest and dividend not taxable in the hands of REIT. Yes, Geeta, you are correct. The interest and dividend will not be taxable in the hands of the REIT. Yes. Because of the pass-through status. Yes, correct, Geeta. So it shall be interest. There will not be any taxability due to the pass-through status under 1023 FC. Also, you have to write that the Beta Limited is not required to deduct any TDS on the interest payment to the business trust under 194A. This shall be taxable. Yes, you are correct. In the hands of the unit holder. Yes, Mansha, you are right. It is taxable in the hands of the unit holder, and the TDS under 194 LBA needs to be deducted, which is 10% on the resident and 5% on the non-resident. You're very correct. Secondly, whether the entire amount which is there. Yes, Geeta, you're right. Unit holders, resident 10%. That's not the tax rate for resident, Geeta. That is the TDS rate. The tax rate for the resident is the normal tax rate, the slab rate, which will be, or if it's a company, then in that case, there will be the company or the partnership form. Depending on that, there will be that tax rate. So the tax rate is not 10% and 5%. For the non-resident, the tax rate is 5% under 115A. But for resident, the TDS is 10%. And even for non-resident, the TDS and tax is both 5%. Yes, Mansha, you are correct. So question to you is whether the entire amount is to be considered as interest. How much amount will be interest? So 10 crores is distributed, right? 10 crores is distributed. So how much of 10 crores is interest? Yes, Namrata. But how much of 10 crores is interest? Whether the entire 10 crores is basically to be considered. So you will, if you remember, I told you section 115 UA says that the income of the REIT will be taxed in the like manner and to the same extent in the hands of the unit holder. So this 10 crore which is there, out of that, you will consider You can just write it over here. So interest will be 10 crore into 4 crore divided by what is the total income of the REIT? What is the total income of the REIT? Yes, tell me. Yes, students, what is the total income of the REIT? 11.1, right? So this will be 11.1 crore. So your interest will be 10 into 4 divided by 11.1, 3.6 crore taxable in the hands of unit holder. This is exempt in the hands of REIT. Right? So section 11 UA provides that income of the REIT shall be taxable in the hands of unit holder in the like manner and to same extent. Okay. Now dividend income from beta, again this will be exempt in the hands of REIT. This will be for resident normal rates, TDS at the rate of 10% under 194 LBA, and for non-resident this shall be 5% under 115A, TDS also at the rate of 5%. Okay. Now the dividend is exempt in the hands of REIT. Beta does not opt to pay tax under 115BAA. So if beta does not opt to pay tax under 115BAA, this will not be taxed in the hands of the unit holders as well. Are we getting that? So since beta does not opt for 115BAA as well as unit holders, as beta doesn't opt for section 115BAA. Then short-term capital gain on sale of the listed shares of the SPV. So REIT is earning the capital gain on the sale of the listed shares of the SPV. What it shall be? It's a short-term capital gain. What will happen to that? Manish, what is 21 crores? The total income of REIT is 11.1 CR. It is 10 lakh and not 10 crores. I think you're mistaken over there. What will happen to STCG? Yes, Namrita, at what rate it will be taxable in the hands of REIT? Yes, Manish. Yes, students, faster. Yes, Geeta, this will be taxable in the hands of REIT at the rate of 15% under triple one A, and in the hands of the unit holder, this is exempt under 1023 FD. Tell me one thing. What if it would have been a long-term capital gain on the sale of listed shares of the SPV? At what tax rate you would have considered? Yes, Mansha, you are right, 15%. But what if it was a long-term capital gain on sale of the shares of SPV which is listed? What would have been the tax rate? Long-term capital gain on sale of listed shares of SPV. No, Namrata. Check very carefully in the chart that I have mentioned. No, Geeta. Namrata, no. It's not 10 or 20%, both. Let me see who gives me the correct answer. I'm sure most of you are going to make mistake with 10-20%. Look at the chart that I just made it. No, Mansha, that's not correct. If you look at the chart that we made it, I said any other income is taxable in the hands of REIT. LTCG, which is covered under 112, will be at 20%. STCG, which is covered under triple one A, is at 15%, which is the rate under those sections. Any other income will be at MMR. Now, this long-term capital gain on sale of listed shares will not be covered under 112 but under 112A. And if it is going to be covered under 112A, 112A has not been created as an exception over here. So that will be taxable at MMR. The only exception is only for 112 and triple one A. LTCG on sale of listed shares is not under 112 unless we don't satisfy the conditions of 112A, which is not the case over here. So that shall be taxable at MMR. You can write it over here. If it would have been LTCG on listed shares, then this shall be at MMR. Fine, students. Then next one is short-term capital gain on sale of developmental properties. Yes, students. STCG on sale of developmental properties. For students, yes, correct, Mansha. It is at MMR. In the hands of REIT. In unit holder hands, this shall be exempt. Then interest on the investments in unlisted debentures of real estate companies, 10 lakh. Yes, Geeta. Yes, Namrata. Correct, MMR. What about the interest? How about the interest, students? No, Namrata. That's the catch over here. This is not going to be exempt. This is not like the interest from Beta Limited. The interest income from the Beta Limited is different from this interest. This is interest from investments in unlisted debentures of real estate company. Only the interest from the SPV is exempt in the hands of REIT and is taxable in the hands of unit holder. So if you look at it, I told you only about this interest. Any other income is at MMR. Is it the interest received from Beta Limited? The answer is no. This is from the unlisted debentures. So even this shall be taxable at MMR in hands of REIT. You can write down only interest from SPV is exempt. Are we getting that? So this will be exempt in hands of unit holder. Correct? Are we getting this particular point? Last one, the rental income of 2.5 crore. Rental income. Yes, Namrata. Yes, Geeta, you were correct. Rental income. Yes, Namrata, right. What about rental income? Yes, Namrata, exempt in the hands of REIT. You have to also write that there will not be any TDS deducted on the rental income. This shall be taxable in the hands of the unit holder. And there will be TDS under 194 LBA for resident, 10% for non-resident at the rates in force. So this rental income, which is of 2.5 crores, sorry, this shall be 10 crores into 2.5 crore divided by 11.1 CR. There's no specific rate of tax for this, but the TDS is there under 194 LBA. For resident, it is 10%. For non-resident, at the rates in force. Yes, Mansha, very good if you are able to remember the section. Yes, Namrita. Yes, correct, Geeta. Very good. Okay. I hope the REIT concept is pretty clear with you. You will be able to solve a sum if it comes in the examination. You can expect a sum on this with the adjustment on the repayment of the capital, which is under 56 to 12 now. Yes or no, students? Yes, before we go on for a break, any questions, any misunderstandings with this? I hope this is pretty clear. So now take up a break, get refreshed, because the next one is a very, very lengthier, very, very important and um, not so easy a topic, which is the charitable trust. Again, a very important topic where you can expect a straight away question on that. So let's take a break of 10 minutes. Okay, Namrata has a doubt how distribution is done. Namrata, the distribution is basically done as a kind of payment to the unit holder, just that they get a statement as you had it in AIFs and the securitization trust. These trusts provide a statement to the unit holders as what has been the nature of the income that they have earned during the year, so that when it is getting taxed in the hands of unit holder, the unit holder is able to divide the distribution into those categories of the income itself. Clear? Okay, so let's take a break of 10-15 minutes and then we get back. Let's take a break. Ashokji, break. Krishna, your question is wherever maximum marginal rate is applicable, does that mean the MMR as per 229C, for example, in AOP, BOI, REIT and trust? Yes, you're correct. That's the maximum slab rate which is applicable for the individual, which is basically the 30% tax rate. And on the top of that, there is the surcharge. The surcharge is 37% if you go for the normal tax regime. If you're going under the optional, it is 25%. So that's the highest slab rate. You're correct. That's the MMR. Okay. Okay. So let's start with the new topic, which is the charitable and religious trust. Okay. Or let me call it, instead of charitable, I'll write it as public trust. We have done so far the private trust and the REIT, InvITs and all of that. Now we are going towards the public trust. Now here there are two regimes which are applicable. One is Section 1023C, which we call it as first regime, and the second one is Section 11, which we call it as second regime. Okay, so there are two regimes that we are going to talk about. One is Section 1023C, and the second one is Section 11, which is we call it as second regime. Fine. Now let's discuss the first regime, which is Section 1023C, and then we move on towards the second regime. Now, if you go for the first regime, there are certain trusts which are specifically covered under the first regime. So under 1023C, there are certain trusts which are specifically covered under 1023C. So it covers certain specific trusts. Now, what are these specific trusts that I'm talking about? Let's try and understand. So these are specifically granted the exemption without them fulfilling any conditions or whatever. These are specifically covered. For example, the Prime Minister National Relief Fund, Prime Minister's Fund, or the Swachh Bharat Kosh, Clean Ganga Fund, which have even the exemption on the donations that you pay to them under ATG. Chief Minister Relief Fund, these are the specific funds which are covered under 1023C. So whatever income they earn, that is exempt. The second type of trust that are covered under 1023C are the university or the hospitals, the university or the educational institution, which is existing solely for the education purpose. Solely for the educational purpose, and which is wholly or substantially financed by the government. Substantially financed by the government. That is one. And similarly, it exists even in the case, similar condition is there for the hospitals as well. So the hospitals which are wholly or substantially financed by the government. This is the second kind of institutions which are covered under the 1023C regime. Now, understand here very, very important part. What do we understand by the substantially financed by the government? What do we understand by substantially financed by the government? So when I say substantially financed by the government, Section 1023C says that if it will be considered as substantially financed by the government if the government grants to the university, educational institution or hospital is greater than 50% of the total receipts. Is greater than 50% of the total receipt. So in that particular case, you can say that it is substantially financed by the government. So if my government grants for the university, hospital or the educational institution is substantially financed by the government, meaning if the total grants are more than 50% of the total receipts. If the government grants are more than 50% of the total receipt. You can mark an asterisk over here and write down government grants greater than 50% of total receipts. Then I can say it is substantially financed by the government. Fine. So in that particular case, under 1023C, the entire income will be exempt without any conditions. The entire income will be exempt under 1023C. The third category, which is covered under 1023C, is the universities or the educational institution which are existing solely for educational purpose, but these are not substantially or wholly financed by the government. These are not government institutions. But if their annual receipts do not exceed rupees 5 crore and if annual receipts less than rupees 5 crore. Similarly, we have the condition even for the hospitals. So hospitals which are there, right, which are existing solely for philanthropic purposes and not for the purpose of profit, right? If the annual receipts are less than rupees 5 crore. Okay. Now, understand one thing. These are not financed by the government. These are not financed by the government. These are the just non-profit educational institutions or non-profit hospitals. Now, in that case, if your annual receipts are less than rupees 5 crores, then in that particular case, you will be exempt under 1023C. But here, there is one more additional condition which was introduced in the Finance Act 2022. It says if you have both university as well as hospital, the combined receipts of both should be less than 5 CR. The combined receipt of both shall be less than the 5 CR. Are we getting that? So if let's say for example my receipts from education is 3 CR and receipts from hospital is 4 CR, individually it is less than 5 CR, but combined is more than 5 CR. So I will not get exemption under 1023C. Are we getting that? So just write down. Receipts from both shall be less than rupees 5 CR. Example, hospital, rupees 4 CR, university, rupees 3 CR. Combined receipts greater than rupees 5 CR. Therefore, section 2023C not applicable. Yes or no? Any questions? Yes? Did we understand this correctly? Are we clear? Okay. Now this is the third category which we have spoken about. The next one is these are unconditionally exempt under 1023C. Without any condition, these categories are exempt, which is education and medical, substantially financed by the government or wholly financed by the government. The specific trusts which are covered, the education and medical where the annual receipts do not exceed rupees 5 crore. The next ones are the charitable and the religious organizations, which are operating for charitable purpose or for the religious purposes, or the educational institutions whose annual receipts exceed 5 CR, or the medical institutions whose annual receipts exceed rupees 5 CR. You can write it over here. It should not be not applicable. You can write like this, unconditional exemption not applicable. Unconditional exemption not applicable. So then the third category is, what do I mean by the conditional exemption and unconditional? You can write for this, for all these three, exemptions without any conditions. Then you have the D1, which is charitable or religious institutions the educational institutions or hospitals having annual receipts greater than 5 crore. Okay, so these are covered under D. So here the exemption under section 1023C is subject to approvals and registrations. So here you are required to obtain the registrations and you are required to get it approved from the principal commissioner. Otherwise, you will not get the exemption under 1023C. So it's not an unconditional exemption. This is a conditional exemption. Only when you are getting the approval from the principal commissioner, only then you can get the exemption. Are we getting that? So just write it over here. Registrations from the principal commissioner of income tax or commissioner of income tax. So any institution which is established for the charitable purposes or any institution which is wholly for religious purpose or for religious and charitable purposes, or any universities which are existing solely for educational purpose where you have crossed the threshold of 5 CR. Similarly, hospitals for philanthropic purposes where you've crossed the threshold of 5 CR. In that case, unless you obtain the approval from the principal commissioner of income tax, until then you will not get exemption. And that's why I said this is the conditional exemption which is given. You have to satisfy the principal commissioner that your objects are for the charitable, religious, or for the educational or the philanthropic purpose in case of hospital. Now, one of the questions that arises in the case of the charitable or religious trust is in regard to the educational institutions. Right? So, one question that arises, like imparting the training or education in, let's say, a specialized field like awarding diplomas or giving any kind of certificate courses, whether that would constitute as an educational purpose. My question to you, what is the educational purpose that we are talking about? What is the educational purpose that we are talking about? Whether it will include any certificate courses, granting diplomas, whether that will be eligible for 1023C. Yes. There's a case law on this point. What do you think? Yes, Namrata, there is a definition of charitable and religious trust that we are going to cover later. For now, we are on the educational institution. What do you think, whether granting diplomas will give the exemption? Yes, students. Yeah, education recognized by Indian law. So yes, Namrata, there's no necessity that it has to be a formalized education. It can be any education. It could be diploma, it could be any kind of certificate courses. It is not mandatory to impart the education only for the recognized educational courses. So it should be only for that it should be in case of imparting the training for the general public. It should not be only for certain employees that the institutes are opened up. Those kind of course, the institutions will not be covered under 1020 PC. It should be general training, but it can be diplomas and even certificate courses. That has been held by the Supreme Court in St. Peter's Educational Society case. So you can write it over here. Put an asterisk mark on educational and write it below. Educational purpose shall include certificate courses and diplomas for general public. Okay. Now there is one more very recent one and very, very important case. That what do we understand when we say that there is an institution which has to solely engage itself in education? What do we mean by this particular point? When I say solely for educational purpose, what do we understand by solely for educational purpose? Does it require it to have only the educational profits and no other profits at all? Or can it have even the incidental profits? So, what do we understand by this particular point? That is something we have to understand. So, we understood that where the educational institution is existing, it need not be only engaged in educating the specific population. That's what Supreme Court held in the case of St. Peter's Educational Society. There it held that where an educational institution carries on the activity of education primarily for educating the person, the fact that it makes the profit does not lead to the conclusion that it ceases to exist solely for educational purpose. It doesn't mean that if I'm generating profits, it doesn't mean that I am not engaged in the educational purpose. Generating profit doesn't mean that I have to generate profits, right? But what is important is I should plow back that profit into the charitable activity again, or into the educational activity again, not the charitable, the educational activity. So the purpose of education should be predominant feature rather than the profit generation. My main object should not be to earn profit. My main object should be to provide the education. So I am doing an activity, I will generate profit. But if my objective is to earn profit, then I'm not an institution which is existing for the educational purpose. But if after meeting the expenditure, incidentally there is a surplus, it will not cease to be an educational institution or institution existing solely for educational purpose. So I have to ascertain whether my objective was to make the profit or what was my objective to educate the person. That is very, very important. So I have to take the note of that particular point. If my objective is to make the profit, then I am not existing for the charitable purpose or for the educational purpose. Then I am existing for the profit motive, then I am not covered by 1023C. But where my objective is to make the education, is to provide the education, then I am not then I am covered by section 1023C. Right? Now understand this particular point very, very carefully. In the Noble's case, the Supreme Court again had the occasion of examining what do we understand by solely the educational purpose, whether I should not be earning the profit at all or I can earn some incidental profit. This was the Supreme Court judgment delivered last year in the New Noble Educational Society. Now, what was the question before the Supreme Court? Understand this very, very carefully. This was the Educational Society which filed for the approval under 1023C because it had crossed the annual receipts of more than 5 CR. So it had filed for the approval. As I said, you can only get exemption under 1023C only if you are getting the approval from the PCIT or CIT. If you are not covered by substantially financed by government or you have receipts more than 5 CR. Now, the application of this educational institution was rejected on the ground that the objectives in the Memorandum of Association were not exclusively for educational purpose. So what do we understand by solely for educational purpose? Can I not carry out any other activity? The matter reached to Supreme Court. And the Supreme Court examined what do we understand by institution existing solely for educational. The Supreme Court said that when granting the approval for registration, you have to understand, the revenue has to understand that the society may not directly run the school imparting education. Sorry. So basically, the objective of the trust should be to impart the education. And whether it is engaged in education or not, you need to consider the objective. Now, basically, if you are looking at it, at the time of giving the approval, the revenue only has to look what are the objectives of the trust. It need not look at the stage of granting the approval, what are the profits which are generated, how these profits are utilized. That need not be looked at the time of approval. That you have to monitor at the time of assessment. So just because the institution is generating the surplus, it is not a ground for rejecting the approval under 1023C. At the time of giving the approval for 1023C, you have to just see what is the object of the institution. So if you look at the language in 1023C, it says the university or educational institution existing solely for educational purpose and not for the purposes of profit. Now, if let's say for example, the profits are earned let's say some business is carried out, which is incidental to the attainment of the objective. And let's say, for example, it has a separate books of accounts in respect of that incidental business. Then even those profits will be exempt. So while construing this requirement, the expression solely, what do we understand by the solely for the educational purpose and not for the purpose of the profit? The expression solely is very, very important. So the institution should have all the objects which are there, which are aimed at imparting or facilitating the education. So therefore, the trust or the institution can have certain other business which is incidental to the business of the education, which is incidental to the attainment of the objective of the education. It doesn't mean it should only be engaged in education. If it is having any other incidental business and it also maintains a separate books of accounts for those business, then even those profits can be exempt. Are we getting that? So basically, the court in this case held that if you look at section 1023C, the requirement is to solely engage itself. You cannot say solely only means that you cannot have objects which are unrelated to the education. So objects which are relating to the education, imparting the education is covered. The term solely does not mean predominantly or mainly. Solely means to the exclusion of all others. So where the institution is profit oriented, you are not covered under 1023C. But that doesn't mean just because you're earning surplus during the year, that will not prevent from granting the approval. So if you are having incidental to the educational activity, any profits that are accruing, for example, sale of textbooks, providing the school bus facilities, providing the hostel facilities, that will not disentitle you from 1023C. However, let's say, for example, where the school is providing the ground, let's say for business events, for conducting these seminars, where the outsiders are also permitted to pay for the rent and conduct the seminars or workshops, then it cannot be an incidental activity to education. Because that is not an incidental objective. Are we clear? So just write it down over here. Just write it down. Educational institutions engaged solely in education and not for profit means it means that the educational institution should not be engaged in business, should not be engaged in any other business activities unrelated to the objective of imparting education. The term solely does not mean predominantly. The term solely, the condition used is solely for educational purposes and not for the any other purpose. It does not mean that I should be predominantly engaged in only education. So there has been a difference in the wording, which means what is my predominant object versus what is my sole object. You cannot use a predominant test over here. So the test of predominant means that I should have mainly these activities, whereas here the term used is solely these activities. If the term used would have been predominant object, so in that case, one can say, okay, if I'm doing anything else also, and mainly I'm doing education, I should be granted registration under 1023C. But the Supreme Court said, no, that is not the case. Here the term used is solely. And the solely means that you should be only engaged in this activity and any other incidental activity which is towards the attainment of this objective. So the basic provision which is granting you the exemption, that is restricted by the word solely. It is not saying your main object should be education. No. It is not saying your predominant object should be education. It's saying it's exclusively this objective should be there. Are we clear? But it means exclusively. Right? If the institution carries out any other activity which is incidental to the objective of education and maintains the books of accounts, maintains the separate books of accounts, it shall be entitled for section 1023C exemption, and even the profits from incidental activities shall also be exempted. Fine. For example, sale of books, operation of buses or hostels. Okay, these are the incidental activities. However, renting of premises to outsiders for seminars, not an incidental activity. Okay. Further, earning surplus is not a bar on exemption under section 1023C. Also, at the time of granting the approval, the revenue should look for objects of the institution and not the surplus generation and utilization. Supreme Court in New Noble Society. This could come as a part of case laws, right? Any questions, any doubt? Yes, Mansha, you were correct. Namrata, not the main activity. Now, did you understand? It cannot have a predominant purpose. The word uses solely. Can trust invest in climate finance? Mansha, it depends on the objective of the trust. Yes, Namrata. Namrata, that's a condition which is given under section 1023C itself, which says that if you have any incidental profits, which is incidental to the generation of, which is incidental to the main activities, then you need to maintain the separate books of accounts for that. That's a particular provision under 1023C itself. Yes? Any questions, any doubt? Okay. Is the first regime entirely clear? Yes or no, students? Pastor? Yes or no? Okay. Now, the second regime which is there, which is under section 11, that is basically, yeah, you can write it over here that the 1023C shall also apply to any other profits if those profits are incidental to the attainment of the objectives and the separate books of accounts are maintained for that. You can write it over here itself. Section 1023C applies also to profits from incidental activities to the attainment of objective, and if separate books of accounts are maintained. Okay. Yes. Now is it clear? Very good, Namrata. Very good, Geeta. Okay. Now in the second regime, what is covered is only the charitable and religious trust. And the second regime, we have the charitable and religious trust. Now, today what we are going to finish is only the meaning of the charitable and religious trust. We will not get into the income computation of the trust, but we are just going to discuss what is the meaning of the charitable and religious trust. What is the meaning of the charitable purpose, which will be equivalently applicable for 1023C as well. Now, section 2, subsection 15 defines the term charitable. So just write down charitable purpose under section 250. Now, what all does it cover? So, section 215 defines the term charitable purpose as including the relief of the poor, second, education. Here it doesn't say solely for education. Here it just says education. My objective should be education. Yoga, medical relief, then preservation of environment. So what you asked just about the climate relief, this could be covered here. Preservation of environment, like the forest, wildlife, preservation of monuments, or any other places or objects of the historic interest or artistic interest. And finally, any other object of advancement of any other object of general public utility. General public utility. Now, advancement of any other object of general public utility. So, what does this mean? So, the section itself clarifies through a proviso that the advancement of any other object of general public utility will not be a charitable purpose if it involves carrying out the activity in the nature of trade, commerce, or business for a consideration which is charged. So you can write it over here. This shall not include the carrying out of any activity of any activity of or activity in the nature of trade, commerce, or business. But there is an exception to this point as well. There's an exception to this. What is the exception? Unless the activity which is in the nature of trade, commerce, or business is undertaken in the course of carrying out the objective of this general public utility. And the receipts from such other business do not exceed 20% of the total receipts. So the exception is if the activities are undertaken in the course of advancement of the object of general public utility and the receipts from activity are less than 20% of total receipts. Then it will still be categorized as the advancement of the object of general public utility. Are we clear? Now, again, there is a case law on this particular point, which is again by the Supreme Court delivered last year in the case of Ahmedabad Urban Development Authority. Now, what was that case about? The question before the Supreme Court was, when an activity be considered as trade, commerce, or business for attracting the provisions of Section 215, the proviso to 215. When can we say that this is the basically the activity in the nature of trade, commerce, or business? So, in this particular case, the Supreme Court observed that. What do we understand by this? First of all, trade, commerce, or business. So, the position with respect to what kind of activities the general public utility charities could undertake, for that they looked into the history of the amendments that have been made into the charitable trust for the taxation of the charitable trust. So it is very well clear that the historical amendments suggest that there has always been a prohibition applicable to the charitable trust which are engaged in the carrying out of the trade, commerce, or business activity. So that one should not give them the exemption because they are not undertaking the charitable activities at the first place. Are we getting that? That is why this proviso was introduced. And that is why this bar has been imposed. So, the careful analysis of this proviso suggests that the bar is to engage in trade, commerce, or business, or to provide any service in relation to trade, commerce, or business, wherein the consideration is charged for that. So, if you look at this, there has to be no involvement of the charitable trust into the activities of the trade, business, or commerce for a consideration, or any kind of activities in relation to trade, business, or commerce. Now, that doesn't mean that all kind of trade, commerce, or business will be out. So long as the predominant objective of the general public utility trust is charitable, and so long as the profits are incidental to the main object, what we even discussed in New Noble. Same point is being discussed in this particular case as well. So to determine if the activity is a commercial activity, you have to decide whether the markup on the cost, whether the profits which are generated on the cost are nominal or significant. In this case, the limited point which was upheld was that when you have to judge that whether you are engaged in trade, commerce, or business, you have to see the receipts and income. So you have to see that whether the receipts of the relevant year, if you look at it, what is the profits which is earned on that? To decide whether the activity is in the nature of trade, commerce, or business. So basically, you have to look at whether the profits are very high or are nominal. And if the trade, commerce, or business is in the course of achieving the object of general public utility, and the income is incidental, and you are maintaining the separate books of accounts, then you are not breaching the condition. Are we getting that? So you have to look that if the accounts disclose that only a nominal markup is charged over and above the cost, the activity may fall under the description of advancing the general public utility. However, if there is a significant markup, then you are getting into the trade, commerce, or business. And then you utilize then you think about that whether you are breaching that 20% quantitative limit or not. So first of all, I need to decide whether I am into trade, commerce, or business before I get into the exception. Are we getting that? If the activities are incidental, then there is no problem. If the activities are not incidental, then you check whether you are crossing the 20% threshold or not. And here, in fact, they had even referred to the ICAI's example as well. In this case, they had even referred to ICAI example as well. They said the bodies like ICAI, which regulate the profession and which are giving these compulsory courses to be qualified as a CA, whether they carry out any kind of incidental activities to regulate the profession or whether they are doing the trade, commerce, or business. So if you look at it, they are carrying out the incidental activity because all the activities are towards regulating this particular course. And it cannot be said that these are in the nature of trade, commerce, or business. They are, whatever activities are there, they are regulating they are towards regulating the profession and to monitor the conduct of its member, and they do not carry out the activities in the nature of trade, commerce, or business. Are we clear? So you have to examine whether the amount which is, let's say, collected by the ICAI for purchase and filling the forms, for the examination, for circulating the brochures, whether it is significantly higher than the cost. If it is significantly higher than the cost, then you fall under this particular limb. Which limb? This one. year. And then you need to test the exception. But whether you get into this or not is the subject matter of what you need to ascertain. Identify if the markup on cost is nominal or significant. If it is significant, test the exceptions. If it is nominal and activities are incidental to the objective of general public utility and separate books of accounts are maintained, not in nature of trade, commerce, or business. Write down Ahmedabad Urban Development Authority. Supreme Court in Ahmedabad Urban Development Authority. Okay, students. Mansha, that depends again if it is investing in stock exchange, whether it is for the profit or whether it is any incidental. Yes or no, students? So we'll stop here. I want you to revise what we have done. In the next class, what we are going to do is we are going to start with the income computation of the charitable trust. And then finally, we'll be discussing about the registrations of the trust. And with that, we'll be finishing off this entire topic. Now, the income computation is very, very, very important. More than the registration, that's the most important topic. And we'll, have the flow which will help you understanding this topic very easily. So do not worry about that. And then finally, we will talk about what are the conditions, what are the timelines which are there, because there have been certain amendments in the timelines for the registrations of the trust. So we will have to talk about that. That is something which we'll look at it. And what are the cancellation of the registration? What are the procedures for that? Mandatory filing of the return of income. All of that procedural component is something we will look at it. But first we'll talk about in the next class is the income computation. Clear? So if you have any questions, I'll be happy to take up. Otherwise, we can just close the session. Okay. So thank you so much. See you in the next class. We can close the session.